So today we're going to, you can't really understand what you're doing in trading unless you have a better feel for where it came from and why we're doing it. Okay? If you're just trying to figure out when to push the button, I may have some success getting you to push the button at the right time. But if you don't know why you're doing it, or where it came from, or what the logic is behind it, you're never going to be, really good at it. Okay? So today, we're going to go for about 45 minutes, I hope. I haven't timed this event, but we've noticed, Connor and I have talked about that, we've noticed that people are actually liking our events a little bit more lately that are just a little bit shorter than an hour. We don't want to take up as much of your time. In this day and age, it's hard to carve out enough time, throughout your day. So we're going to make a conscious effort at getting to the point a little bit more quickly. I know that's going to cut some people out that are looking for more and more and more detail. So we will certainly have media for them to find more detail. In fact, Connor, I know you're going to have to dig this up because I didn't tell you this ahead of time, but put the link to the wiki on, where there's a lot more information about what we do, why we do it, how we do it, and the indicators that we use to do it, and what each indicator does. Okay, so you're going to get a whole lot more out of that than you will out of just sitting and listening to videos if you're looking for a lot of detail. Okay. So today we're going to talk about where I found the edge and how I found it, and the why we use 1 minute when we trade, the indicators that we use, what they do, and then I'm going to introduce you to the Rockstar indicator and the just a quick. I'm just going to show you quickly the setup. I'm not going to explain it so much. But then on Thursday, we're going to actually go into the Rockstar trade setup, okay? You'll notice on Saturday it says Naked Rockstar trade setup. Those are very similar trades, but they have some differences to them. We treat them as really two different trades. Although eventually you'll just see a setup and you'll trade it, and you won't necessarily distinguish between whether it's a naked or not naked Rockstar. You just know that by the rules I can take this trade. Okay, so we're going to talk about the rules for the Rockstar setup tomorrow, and tuning those rules, or at least giving you options to tune the rules to suit your risk tolerance. And again, using driving as an analogy. You may find yourself to be a more or less aggressive driver. You might be a very conservative driver or a very aggressive driver. You can do that with trading our system as well. And if you want to take more trade setups, there are easy ways to do that with simply using some of the options that we have available to us to tune your style of trading. Okay. And then Saturday, we will talk about the Naked Rockstar trade setup and the rules, and also the speed tick trade setup. We're also going to take a quick sneak peek at our new Trader RX accountability program. We had what we called our Trader RX program previously that was a full mentoring program. Okay, and it being a mentoring program, that means your mentor devoted an awful lot of time to helping you. We've retooled that program so that it's not so much a mentoring program. I mean, one of the major benefits of the mentoring program was that you were now accountable to your mentor. Okay, so we're still going to have that accountability, but you're not going to have somebody who's analyzing. You're not going to have somebody who's just being your mentor. We've kind of spiced it up a little bit, and I think it's going to be a lot of fun and a great program to help you guys stay on the right path. Okay, And then, of course, we're going to have our Q&A on Saturday. Depending on how time goes today, I really do want to keep it around 45 minutes. I might take a few questions today, but I'm going to try to put them all off to Saturday, okay? All right, so now, first of all, where did I find this edge? And how did I find it? Okay, so if you look at any chart, you're going to see things that look like this. So obviously we have an upward trend, right? Well, we've got these momentum traders that come in and they create an opportunity for us. That opportunity is by and large lost on most people. In fact, a lot of people think that it's stop hunters or whatever, that they're out there just taking our stops before they turn the market around, and that's really not the case. These guys, these momentum traders, are looking for price to start moving out of a channel, okay? So, or breaking out of a range. All right. So the idea, I'm going to cover up this chat because I tend to look over at it. So I'm not going to take any questions right now. I'm not even going to read the chat. So if you ask questions, Connor can try to answer you, or best to just wait or email them to me, okay? So we've got this these areas of channeling, okay? So what we're looking for is when price breaks out of this channel. All right, when price starts to break out of this channel, the momentum traders are looking for a relative amount of breakout, okay? So it really doesn't matter the size. They're looking for the breakout is not a fixed amount or percentage of the market. It's relative to the recent past conditions, which would be, this area, okay? And momentum traders are always looking to take advantage of a trend. All right, so their characteristics are that they're going to trade levels within a trend. Okay, so what's a level? Here's a level, a level, a level, a level. Notice that it's still the uptrend, but they're trading these levels above a trend, okay, or inside of a trend. They're trying to capture these small moves based on the aggressive buyers and sellers either bidding price up or down by overwhelming one side of the bid-ask spread, and we're setting off a strong move that is in one direction, usually temporarily, okay, and it's almost an artificial movement in price. Now, you will notice, if you look carefully at this chart, these longer bars, relative to the previous bars, sudden longer bars, and then price does something, suddenly changes. Notice the longer bars, and then something changes, okay? This is what drew my attention, okay? I started looking at, why does price stop and turn? What's going on inside this bar? And why does it happen after these bars that are generally bigger than the previous bars? Okay, so it suddenly kind of stuck out to me like a flag waving at me, like, over here, dummy, I've been here all along. You just got to pay attention. So what's going on here? All right, so this is going on inside every liquid market. It happens every day as long as people are trading, and there are traders in the market. Now, we need a lot of people. We need a lot of traders. We need a lot of activity. We're not going to do as well like recently when the volume was split between two different contracts, because we do trade futures. We're not going to see the type of volatility that we like to see. So we want to see a lot of volatility, a lot of activity. This is why we trade in the mornings in our trade room, because you're going to get more predictable volatility, which is being predictable is what it's all about. So we look here and we can see that price is channeling, or it's in a tight range. Now, why is this happening? We don't necessarily know, and it doesn't necessarily really matter to us. It could be that there's just nothing going on, that's what it feels like to us when we're trading, right? We're just sitting there bored. We're thinking, wow, nobody's trading. Nothing's going on. And it could be that. But on the other side of that, it's just as likely that it's an area of accumulation or distribution that these guys that are the market manipulators or the market makers are actually acquiring all the assets that they can at a very low volume at a very low rate, and then they start doing their thing after they've acquired all the available assets at this low price. Okay, so I start looking at this, and so it could be accumulation, distribution. I don't really care. Then you start noticing that the buying sentiment or selling, it could go either direction, it doesn't matter. Just in this example, it's the buying sentiment, increases with a sudden kind of bidding up of price. Now, this may or may not be the climax bar or the sudden upthrust. It can happen immediately coming out of the channel on one bar, or it could happen over several bars. Okay, usually not more than, you're not going to see more than 2 or 3 of these big bars together, as we're breaking out of a channel. All right, so we're looking for this sudden bidding up of price. This bidding up of price, breaking out of this range, has now triggered the momentum traders. Okay, now they're these breakout traders. You hear them called breakout traders sometimes. They're trading a breakout. Okay, so what they want to do is they want to buy early in the breakout and then sell it later in the breakout, but not too much later, because they don't want to be caught holding it either. So they're going to start driving up the price even higher over the short term by buying up as much as they can. Well, what's happening when they're buying all this up is they're decreasing supply. Well, what happens when supply gets decreased? Price goes up. All right, so we're bidding up the price, and up here, just a little bit up from where they bought it, they're starting to dump it off. Okay, so they're making their profit. These are the momentum traders. They want this push, and they don't care how far it goes. They're going to just keep selling it off. So ultimately, and we know by looking at all charts, there are areas of exhaustion where there are no more buyers sitting there waiting to buy, or or thinking that it's a good time to buy. You get a lot of them down here because of the fear of missing out, right? They don't want to miss out. But after it's gone on for a while, everybody knows, well, it can only go on for a while, so I'm not going to start buying up here, because it's going to start getting exhausted. So you hit an area where the buyers are just really, they've lost interest. They're not thinking that it's a good time to buy anymore. And then suddenly these guys start dumping things on the market. So now the market becomes overwhelmed. After they've dumped off, they're going to wait right up in here when they're still buyers, and they're going to start selling like crazy while they're still buyers. And this is what's going to exhaust those buyers. This is the exhaustion point here. I'm going to show you something in a minute. This is called the freight trading part, and this is where they get the last of the suckers to jump in here before the supply overwhelms the demand and price drops again. Okay, so this overwhelm of demand is where our edge is. Okay, so go look at this on any charts, any market. You'll see this all the time, and it's amazing. I kept seeing this, and I had this big aha, and I thought, well, look at this. This is actually regular. This is a regular pattern. We're all about looking for patterns to try to identify an edge in trading, right? We're all looking for a pattern. Any trading system that you're trading is trying to identify a regular pattern that's exploitable. Okay? That's all we do in trading, is find those patterns. And I found a pattern that seems more obvious to me than any of this other random stuff that I had been trying for so many years. You know, the one pattern was the darn trend that I kept trying to follow. So this is an edge that momentum traders create by causing this unnatural increase or decrease in price. Okay? So this is how I found this. Okay? Maybe somebody tried to teach me this once, but I was too thick to understand. I didn't get it until I figured it out myself. Okay? So why do we trade the 1 minute time frame? So I'm going to show you a little video, and I'm going to ask you a question, and maybe this will become a little bit more obvious to you. So we're right here, and we're dropping this ball, right? You see this ball? Everybody see this ball? Well, the ball is just now being dropped, right? So everybody can see that? The ball's being dropped. 5 minutes from now, can you tell me where that ball is going to be? How about 1 minute from now? How about 5 seconds from now? From this moment here that we've captured. Can you tell me where that ball is going to be? With a high degree of probability, can you tell me if it's going to go over here? Is it going to roll off the screen down here? Is it going to hit this guy in the foot? Can you tell me with a high degree of probability, based on the information that we have? Now, we do have information, right? There is plenty of information right here for us to make a judgment about where that ball is going to end up. But the shorter the time frame, the more accurate we're likely to be. Now, if I bring that ball down to here, whoops, down to here, in the next half a second, quarter of a second, can you tell me where that ball is going to be? With a high degree of probability? I'm not reading the chat. But, I mean, it seems pretty obvious, right? With a high degree of probability, I know that ball's not going to hit there and go over here, or off the screen here, or roll over there. I know with a high degree of probability it's going to do that. What happens after that? I have no idea. I have no idea, other than I've seen the video. All right, off it goes. I had no idea with the information that I have here where it's going to go at the end, but I did know with a high degree of probability that it was going to do that. That's all we need. But the longer I wait to use this information, the more speculative the information becomes. Okay? Let's look at this again. Different way. Now let's relate it to trading. Now, we're taking measurements, right? This is what's happening when we're trading, right? We're measuring what's going on inside this bar, right? So there's all kinds of measurements going on that create this bar. There are also measurements going on here to tell us what to expect based on what's happening right now. All right, so you say, well, what do you mean measurements? I'm talking about speed, the rate of that it's dropping, what it's made from. For all we know, this is a beanbag that looks like a golf ball. So we're going to measure the rate at which this is dropping. We're going to measure the density of whatever it's bouncing off of, or likely to bounce off of. For all we know, this is water or rubber or foam or hardwood floor or concrete. There's all kinds of things that this could be. So we need to measure that so we can anticipate the likelihood of a reaction. All right. We kind of know from experience, just from watching, what to expect. If this ball floated, and it just came down like a feather or a snowflake or something, what would you expect it to do when it got to the bottom? All right, so we're using our experience to understand what's likely to happen. What if it was fired out of a cannon? What could we expect to happen to that floor? I mean, it could just get destroyed. It could destroy the floor. It could implant itself 3 feet into the floor. I don't know. There's a lot of things that we're measuring to understand what's likely to happen next. And the force of the drop is one of those things, and a very important thing. So we're looking at the force of the drop here, and we're anticipating, based on the measurements, what's likely to happen next. Okay? So what's going to happen 10 minutes from now? 5 minutes from now? 3 minutes from now? I don't know. I have no idea. But I have a really solid idea what's going to happen right now. Okay? As soon as price hits that floor, which we measured this to figure out where the floor was, we can anticipate a very likely reaction. Okay? So how do we do this? We do this by the measurements, okay? I said we're measuring, right? We're measuring what's going on in the markets. We're measuring every single bar. We're measuring every single tick, okay? So we're going to measure the rate at which orders are being processed through the market, okay? So we're looking at this price channeling, and then we're looking at these areas where you see that price shoots up, okay? Typically, this is a manipulated bar. We know this because of our speed tick indicator. Our speed tick indicator, that's these little white arrows or this blue arrow. These are measuring when price moves at a rate that is unlikely that us little retail traders with our laptops on our Wi-Fi are able to trade that fast. Okay? We're not talking about volume necessarily. We're talking about the rate at which the orders are being processed, because these market makers enjoy certain liberties that we can't take advantage of because we're not millionaires or billionaires, and we don't have supercomputers inside the exchanges. So we don't try to get in on these with these guys. We just want to find out what they're doing. We want to find out when they're manipulating the markets. So we've kind of pinpointed where we think that's likely to be happening. Okay, and that's our speed tick indicator. When we reach a certain rate relative to the rate the ticks have been coming in, when we reach a certain rate, then we can say, okay, this is probably an HFT or a quant or, one of the algos manipulating this bar. Now, we can actually notice that if it's going even faster than that, we say, well, it's still probably some sort of manipulation, but it's going really, really fast. And I may need to be a little bit more careful here because it may be a bit out of control. If we exceed this third line here, then we know that it's probably, the quants can actually fight each other. The HFTs and the algos, they can all get in a battle with each other and cause all kinds of bidding and all kinds of orders being processed. So then we generate a great big dark blue speed tick to tell us, you know what? Probably a bit more radical of price action going on here. I'm going to let those guys fight it out. I'm going to wait until that's done. Okay? So that's our speed tick indicator. The speed tick kind of starts the process of placing a trade for us. Okay, it doesn't start the process of qualifying a trade or a potential trade, but it does start us with that's our finger on the trigger. Okay, so you can see that when price has exceeded that lower threshold, or not price, I'm sorry, when the rate, this is like a speedometer, by the way, and we don't trade with this on our charts. I just showed you that this is how we're measuring. So we've got the rate at which the orders are being processed relative to how they were being processed earlier. The rate has exceeded what would be normal, all right, for normal retail traders. And so we know that there's a good probability that that bar is being manipulated. And if it has been manipulated, we can tell with a high degree of probability what's going to happen after the manipulation. Okay? We also do that with the rate of acceleration using our the same histogram. Maybe we didn't quite get all the way up to the line, but the acceleration was so fast that we can kind of tell that the price is likely to stop and turn. All right, and we kind of caught people off guard, with that acceleration. So that's our ricochet indicator. We also have a pullback alert. This, if you've seen our volume spread analysis webinar, you already know about this. If you haven't, ask Connor and he'll put a link in there for you. It's actually, if you just go into YouTube and you search volume spread analysis, I think ours is the highest rated and most viewed video on volume spread analysis. But what we're doing here is we're reading not just the ticks that come in, not just volume. We're reading and looking for the right kind of volume. Okay? So what do I mean by that? Well, if we look at two identical bars, right? They're identical. And if you're scrolling around on a chart and you're looking for opportunities and you see these two bars, they're not going to tell you anything other than high, low, open, close. Okay? That's it. That's all you're going to learn from these bars. But there's a lot more information in these bars. What do I mean? Well, let's watch the ticks coming into this first bar. So this first bar, the ticks are coming in and price goes all the way up, comes down, the bar closes. Okay? So that was pretty much the life of that bar. Price went up, price came down, bar closed. Let's look at another example. Same looking bar, but price went up, price came down, went up, came down, went up. So the buyers and sellers now start getting very active up in this area. The sellers were just sitting here waiting. The buyers ran into these sellers, and now they're kind of fighting with each other. Well, now, if the bar came from here, went all the way up here, they're probably, several bars or whatever. But this would be a good point to expect some sort of exhaustion, right? Where the buyers are running out of gas, and there's no more buyers up here. So these buyers keep trying to push it, but they're running out of gas. And the sellers are just waiting. And then they get into this area, and if they're exhausted and they've just been sitting waiting, this is a great place for sellers to suddenly take control. All right, so that's our pullback alert. We use divergence a lot. Divergence took everything that we've been doing and ramped it up for us. Really took it to the next level. So if you don't know what divergence is when momentum and price basically are headed in different directions. Typically, momentum and price are going to move together. All right, that's very typical. When price and momentum diverge, you'll notice that this very crude looking chart here, and this is a very crude looking momentum oscillator, but at some point they get out of sync with each other. So you can see that price is still showing a downward trend, but momentum has shifted and it's actually going up. All right, that's typically been, it's always been there. divergence has always been there, but it's always been really confusing. I tried trading divergence many, many years ago when I was a struggling trader, and I heard about it, and I saw some guy talking about it, and I tried to do it, and I just couldn't. I was always missing it or misreading it or whatever. And so I went about looking at divergence again, and instead of trying to figure out what everybody else was doing, I came up with this little algorithm, although, excuse me, it was more a hypothesis than an algorithm. And so I wrote down what I wanted to see, and I gave it to a programmer who was a lot smarter than me about this stuff. And I said, this is what I want to see. This is what I want to have happen. When price diverges from momentum, I want to see an indicator at the open of the bar. Okay, so that's what we came up with. So this is our flash indicator. This is our McDiver indicator. This is the same, we're using the same algorithm, just different momentum oscillators. Well, those work so good, we came up with the Super D. We used those 2 oscillators and then 5 more. So we've got 7 different momentum oscillators using the same algorithm to determine divergence. And with that, we couple all of that with our OBOS indicator, our overbought, oversold indicator, which tells us, remember I talked about exhaustion and the potential for exhaustion? That is very important to us. This is why we measure momentum, because momentum cannot be sustained and will never be sustained in the markets. Okay? Price will always pull back before it either reverses or continues on its way, on its trend. Okay? So if we know that for a fact, why aren't we looking at strong potential for exhaustion? All right, so that's what we look for. We use our OBOS indicator, overbought, oversold indicator, which has several indicators inside of it. You have a lot of choices. We like to use the RSI for the momentum indicator. Now, this is our MOMeter, our momentum indicator. You'll notice that when price is channeling here, nothing's really going on. And suddenly price starts pushing really hard in one direction. Okay? We're measuring that hard push, and we're changing the color of the bars. Of course, inside the indicator parameters, you can make these any colors you want. But we use black, and then it goes all the way to white. So it's basically a scale, and we're measuring the momentum so that the lighter the colors get, the more likely the exhaustion is going to be setting in. That's very important to us. All right. Then we have our velocity indicator. Basically the same kind of thing, but we're looking for a lot of price changing inside the bar. And then our naked rock zone indicator, which we're going to talk more about on Saturday. Excuse me. All right. So quickly, let's talk about this. I talked about the freight training effect. So the momentum traders have caused this unnatural increase, right? This area where price is suddenly breaking out of a channel. And this is where the momentum traders are suddenly like, oh, we're breaking out. Let's go for it. Let's buy a bunch here. Let's run price up. Let's sell it in here. And of course, they got to hope that there are more buyers up in here for them selling off here, right? So we get this sell zone and then this freight training area where the last of the buyers are very eager and jumping in here and getting all excited. You've been that person, right? When you jump in and you buy, and then suddenly it's like everybody knew you bought, because that's when the price started dropping, right? You get that feeling like, oh God, how did that happen? Well, you were one of the buyers that didn't want to get left out. You got fear of being left behind. So we get this last little oomph here of this freight training, and then exhaustion sets in. Okay? So this exhaustion also coincides with the fact that momentum has already shifted directions, and we're picking that up with this difference between this buy and sell zone. We're picking up that momentum has changed, and this is what it looks like to us. Okay, this is what it looks like with our indicators. This is what looks like a trade setup looks like for us. We want to see a confluence of positive conditions. Okay, so the momentum traders need some strong movement with lots of potential buyers trading in order to be able to have that freight train effect. If they get price really rolling, then that helps to push price, giving it more momentum, which is really what they want. They're like getting this ball rolling, and they want to keep it rolling until it just runs out of gas. Now, the important thing is that the move is not predefined. It's all relative to what's been going on in the past. Okay? So it's not like I need X amount or X percentage. It's going to be relative to what's been going on previously. All right? Okay. So just to see if you guys have been paying attention, and I'm going to have some fun with this. I hope you do too. I'm going to give you guys a quiz. And I'm going to see how well I did telling you about this stuff and how well you were paying attention. And this will also tell you how important this is to you if you're really interested in this. If this is important to you to learn this. And I can tell you, tomorrow and Saturday, there will be more of these. Okay? All right, so let's do the first one. This is a 5-minute, should be pretty easy. This is a timed 5-minute quiz. Ready? And here you go. Can everybody see that? I hope everybody. Yeah, I see. All right, now I see you guys are putting in your answers. All right, I'm not going to distract you guys too much. You're about halfway there. I probably gave you guys too much time for this, huh? It looks like about 9 of you haven't finished yet. All right, if you're already finished, just give us a couple more minutes. Just take a quick, go grab some water or something. We'll be done here in about a minute. Waiting on about 6 people to finish up. You're driving. You fail. Mario's giving the answers. Don't look. All right. Looks like everybody's pretty much done here. We're gonna cut it off. If you're not done, got 6 more people still not finished unless you just said, oh, screw it. All right, let's look at the results. You guys can see the results. How'd you do? I see some of you most of you were paying very careful attention. Nice. What happened? Yeah, it looks like several people bailed out of the last 3 questions. So, yeah, you had to scroll down to see the rest. Fail. Well, see, that was part of the test. Fail. Yeah, got to scroll. Nice. All right, so you're going to see these again. Good job for those of you that were paying attention. You're going to see all these again. If you're here on, am I sharing again? Do you see quiz time? Is that what you guys see? Let me shut this down. Okay. All right, so tomorrow we're going to talk specifically about the setup. Oh, you don't see it now? Oh, hold on. Yeah, hold on just a second. I gotta reshare it. You see it now? What the heck? All right, hold on a second. It's refreshing, I think. Yeah, I know. I'm working on it. Here it comes. That was operator error. My fault. All right, so we're going to talk about the Rockstar specifically. We're going to talk about the rules of the star, and we're going to give you options on how to tune those rules to suit your risk tolerance. Okay, so we do have rules for our trade setups, but after you've gotten comfortable with the setups, after you understand them, you see them, you understand, when they occur, why they occur, we give you some options to think about for tuning them to your own needs. Okay, so for those of you that have been waiting for this, we've got our specials again this week. We've gotten a lot of emails asking when we're going to run our specials again, so they're running now. So we've got the academic, the mastermind, and the Einstein that are we're running specials on. Generally speaking, most people prefer the Einstein or will buy one of the smaller packages and then upgrade to the Einstein. I mentioned that new program that we have called the Trader RX that we're developing should be ready in the next few weeks. That all the Einstein people get that for free. So this is an education program where you become accountable to for all of your trade decisions to somebody else, and they're accountable to you. All right, so it's really interesting and fun to watch how people act and react when they know everything they do is going to be judged by somebody else. So and that's a big part of it. Yeah, no, that's for the Einstein only. I thought I said that. Yeah, it's in that's this right up here. That's in the Einstein only. So Einsteiners get that for free. Eventually, other people will be invited to pay for it if they want to participate in the program, but all Einsteiners get it for free. Okay? How'd I do? Oh, I went 5 minutes over. I was really trying for 45 minutes. All right, well, I don't have a lot of time for questions. I hope you guys were all clear on all of this. If you have any questions, send me an email. You can just send it at this support email right here, or save it until tomorrow. It was really just a foundation for what I wanted. Today was just a foundation for what I want to show you tomorrow. But I think the quiz is important also. Kind of get you thinking instead of listening. I want you thinking, right? I want you participating a little bit more for this training. So I will be asking more questions tomorrow, and I promise you they're going to be harder than the ones today. All right, everybody, have a great rest of your day, and we will see you all tomorrow.